Credit just contracted $127 billion. That only happens before recessions. John A.G., The Collapse Files. Educational analysis only. Here's what you need to see. In September 2008, the global financial system came within hours of complete collapse. Not because banks ran out of money, central banks could print unlimited amounts. The system nearly failed because banks stopped trusting each other enough to lend overnight. When Lehman Brothers declared bankruptcy, the interbank lending market froze. Credit, the lifeblood of modern finance, simply vanished. Within 48 hours, ATMs were at risk of running dry. The global economy teetered on the edge of a blackout. Today, in late 2025, credit conditions are tightening at the fastest pace since 2008. The senior loan officer. Opinion survey, the Federal Reserve as measure of bank lending standards, shows net tightening across all major loan categories for 18 consecutive months. Commercial and industrial loan balances at U.S. banks have contracted by $127 billion from their peak. Credit card charge-off rates have risen to 5.2%, the highest level outside recessions since 1991. This is happening while the economy shows no official signs of recession. When credit disappears, not because of panic, but through quiet, systematic withdrawal by institutions that see risks authorities claim don't exist, what does it signal about the gap between official narratives and financial reality? Throughout most of monetary history, credit was inherently limited by the physical constraints of commodity money. To extend credit, a lender had to possess actual wealth, gold, silver, grain, or other tangible assets that could be lent to a borrower. This created natural limits on credit creation and natural consequences for misjudgment. In ancient Rome, credit markets were surprisingly sophisticated. Moneylenders operated openly. Interest rates were regulated. The 12 tables of Roman law set maximum rates at 8.33% annually. Wealthy Romans lent to merchants, farmers, and even to the state. But credit was limited by the lender's actual wealth. If a lender had 10,000 denarii in silver, they could lend perhaps 8,000, retaining reserves for their own needs and potential withdrawals. They could not create 50,000 denarii in credit from thin air. This constraint meant credit naturally contracted during periods of uncertainty or loss. If a lender suffered losses, bad harvests, trade disruptions, defaults, their capacity to lend contracted proportionally. When multiple lenders faced losses simultaneously, credit contracted across the economy. This created cycles, but the cycles were self-limiting because credit could not expand indefinitely beyond real wealth. Medieval Europe added moral constraints beyond physical limits. The Catholic Church prohibited usury, charging interest on loans, as sinful. This theological restriction severely limited credit availability. Kings and merchants requiring loans turned to Jewish moneylenders, exempted from Christian prohibitions, or to Italian banking houses that found theological workarounds like fees and partnerships rather than explicit interest. The critical mechanism was that credit defaults had severe personal consequences. Debtors who could not repay faced imprisonment, enslavement, or seizure of all assets. This made borrowers cautious and lenders discriminating. Credit was extended only when the lender had high confidence in repayment capacity. The system was harsh, but self-regulating. Bad credit decisions led to losses that directly reduced future lending capacity. The Renaissance banking houses, the Medici, the Fuggers, refined credit provision but still operated under fundamental constraints. They could extend more credit than their gold reserves through bills of exchange and letters of credit that circulated as money substitutes. But these instruments were trusted only because recipients believed they could ultimately be redeemed for metal. When doubt arose, as when the Bardi and Peruzzi banks collapsed in the 1340s after English King Edward III defaulted, credit instruments became worthless and credit markets froze. The Bank of Amsterdam, founded in 1609, pioneered fractional reserve banking at scale. It accepted deposits of gold and silver and issued transferable bank money. Crucially, it discovered it could issue more bank money than it held in metal reserves because depositors rarely demanded full redemption simultaneously. This allowed credit expansion beyond physical constraints. The bank could create 1,000 guilders in credit from 100 guilders in reserves if confidence remained high. For 150 years, this worked. Amsterdam became Europe's financial center. But in the late 18th century, the bank expanded credit too aggressively, creating bank money far exceeding metal backing. When depositors began demanding redemption, partly due to suspicions the bank had made large, risky loans, it could not deliver. The bank collapsed in 1791. The lesson? Fractional reserve credit works until confidence fails. When confidence fails, credit vanishes regardless of nominal obligations. The 19th century saw fractional reserve banking become standard practice across Europe and America. Banks could create credit many times their capital base. Economic booms followed as credit-financed railroads, factories, and infrastructure. But periodic crises, 1819, 1837, 1857, 1873, 1893, 1907, revealed the system's vulnerability. Each crisis followed a similar pattern: credit expansion, speculation, rising asset prices, a triggering event, sudden redemption demands, bank failures, credit contraction, and depression. The Federal Reserve, created in 1913, was designed to prevent these credit freezes by serving as lender of last resort. Banks facing redemption demands but holding sound assets could borrow from the Fed, preventing solvent banks from failing due to temporary illiquidity. This was meant to stabilize the credit system by ensuring that confidence crises didn't become solvency crises. But it also created moral hazard. Banks, knowing they could access Fed liquidity during stress, had less incentive to maintain conservative lending standards. The safety net encouraged risk-taking. Credit expansion became easier and more aggressive. The constraints that had limited credit under commodity money or early fractional reserve systems were progressively weakened. The Great Depression demonstrated that even with a central bank, credit could still vanish. From 1929 to 1933, bank failures and credit contraction were catastrophic. The money supply fell by 1/3. Credit markets froze. The Fed's inability or unwillingness to provide sufficient liquidity allowed deflationary collapse. The lesson relearned: credit is not just money, it's confidence. When confidence fails, credit disappears, regardless of institutional structures designed to prevent it. The modern credit system that emerged after World War II represented a fundamental departure from all previous arrangements. Credit was no longer limited by commodity reserves, fractional reserve constraints, or even central bank reserve requirements in any meaningful sense. It became essentially unlimited, constrained only by regulatory rules that could be changed and by confidence that could be managed through policy intervention. The Bretton Woods system, 1944 and 1971, maintained a nominal link to gold through the dollar's convertibility at 35 per ounce for foreign central banks. But domestically, credit creation was divorced from gold. Banks could create credit through lending limited primarily by reserve requirements, the percentage of deposits they had to hold as reserves at the Federal Reserve. With reserve requirements of 10%, a bank with $100 in reserves could create $1,000 in credit through the money multiplier effect. But even this constraint was more theoretical than practical. Banks facing reserve shortfalls could borrow reserves from other banks in the federal funds market or from the Fed's discount window. As long as the system as a whole had sufficient reserves, individual banks could expand credit aggressively. And the Fed could increase system reserves any time by purchasing government bonds, creating new reserves from nothing. After 1971, when Nixon closed the gold window and ended even the international gold link, credit creation became purely fiat, limited only by regulatory rules and central bank decisions. The explosion of financial innovation from the 1970s onward pushed even further. Credit cards, home equity lines, asset-backed securities, derivatives, and shadow banking created credit channels, operating largely outside traditional bank regulation and reserve requirements. The 1980s and 1990s saw progressive deregulation, the elimination of Regulation Q interest rate ceilings, the repeal of Glass-Steagall separating commercial and investment banking, and the growth of the shadow banking system of money market funds, investment banks, and hedge funds. These institutions created credit through repo markets, securitization, and derivatives without being subject to bank capital or reserve requirements. By the 2000s, total credit in the U.S. economy, measured by total credit market debt, exceeded $50 trillion or over 350% of GDP. This included government debt, corporate debt, household debt, and financial sector debt. The ratio had more than tripled from the 120% typical under Bretton Woods. Credit had been created on a scale impossible under commodity money or even early fractional reserve systems. This credit expansion was enabled by and dependent on continuous growth in GDP, asset prices, and debt servicing capacity. As long as these grew, existing debt could be serviced and new debt could be created. The system was not stable in a classical sense. It required perpetual expansion to avoid collapse. But it appeared stable because policy could ensure expansion through interest rate manipulation, regulatory forbearance, and ultimately bailouts. The 2008 financial crisis revealed the system's fragility. The shadow banking system, which had created trillions in credit through mortgage securitization and derivatives, collapsed when housing prices stopped rising. Credit that had been created through complex financial engineering evaporated. Lehman Brothers failed. AIG faced insolvency. Money market funds broke the buck. The commercial paper market, critical for corporate short-term funding, froze. Credit disappeared not through bank failures, but through the sudden recognition that much of what had been treated as creditworthy collateral was actually worthless or of unknown value. The policy response was unprecedented. The Federal Reserve cut interest rates to zero. It created trillions in emergency lending facilities. TAF, TALF, CPFF, PDCF, alphabet soup programs designed to provide liquidity to every segment of frozen credit markets. It began quantitative easing, purchasing treasuries and mortgage-backed securities at scale to inject reserves and support asset prices. The Treasury implemented TARP, $700 billion to recapitalize banks. Together, these programs prevented complete credit collapse. But they also established a new precedent. Credit would not be allowed to contract significantly regardless of the underlying quality of borrowers or assets. When credit froze, authorities would intervene with unlimited force to restore it. This eliminated the natural corrective mechanism, where bad credit was purged from the system through defaults and asset price declines. Instead, bad credit was supported through policy intervention. The post-2008 period saw credit gradually rebuild. By 2019, total credit market debt exceeded $75 trillion, approaching 360% of GDP. Interest rates remained historically low, near zero in nominal terms, negative in real terms when adjusted for inflation. This enabled credit creation despite weak economic growth and deteriorating credit quality. Zombie companies, profitable only due to ultra-low rates, proliferated. Corporate debt quality declined as BBB-rated bonds, the lowest investment grade, became the largest category. The COVID pandemic in 2020 triggered another credit freeze. Corporate credit markets seized. Even investment-grade companies couldn't borrow. The Fed responded immediately, cutting rates back to zero, restarting quantitative easing at unprecedented scale, $120 billion monthly, and creating new facilities to purchase corporate bonds and even junk bond ETFs. The message: credit would be supported at any cost, regardless of quality or market fundamentals. By 2021-2022, this created a paradox. Credit was abundant. Corporations and households could borrow at near zero rates. But this abundance was artificial, sustained by central bank intervention rather than genuine lender willingness based on credit assessment. When the Fed began raising rates in 2022-2023 to combat inflation, the illusion began cracking. Interest rates rose from 0 to 5.25% in 18 months. Companies and consumers that had borrowed assuming perpetual low rates faced refinancing at dramatically higher costs. Banks that had purchased long-term bonds at low yields saw their portfolios lose value as rates rose. Silicon Valley Bank and other regional banks failed in March 2023 due to this mismatch. Credit conditions began tightening, not through policy design, but through market recognition that credit quality had deteriorated severely during the zero-rate era. This brings us to the current environment. The Fed has cut rates modestly from the peak, from 5.25 to 4.5%, but credit continues tightening despite these cuts. This is the key signal. Credit is contracting independent of official policy, driven by lender risk assessment rather than central bank guidance. When the credit system stops responding to policy levers, it suggests we're entering the next phase of the cycle, the phase where artificial credit abundance gives way to natural credit scarcity based on real default risks. The quantitative evidence of credit contraction is visible across multiple categories of lending, all showing simultaneous tightening that is accelerating rather than moderating. The Federal Reserve's Senior Loan Officer Opinion Survey, SLOOS, is the primary measure of bank lending standards. Banks report whether they are tightening or easing standards for various loan types. The net percentage tightening, the share tightening minus the share easing, has been positive, indicating tightening, for 18 consecutive quarters through Q3 2025, the longest sustained tightening period since the data series began in 1990. For commercial and industrial loans, 48% of banks reported tightening standards in Q3 2025 versus 5% easing, a net tightening of 43 percentage points. For commercial real estate loans, 52% reported tightening versus 3% easing, net tightening of 49 percentage points. These levels are comparable to or exceeding the tightening that occurred during the 2008 crisis and far exceeding the tightening during the 2001 recession. But the most telling signal is not just that standards are tightening, but that they are tightening despite economic conditions that are not officially recessionary. GDP growth in 2024-2025 has averaged approximately 2.5% annually. Unemployment remains below 4%. Corporate earnings, while growing slowly, are not collapsing. By traditional metrics, this should not be a period of severe credit tightening. Yet it is. The reason becomes clear when examining loan balances and credit quality. Total commercial and industrial loans at U.S. banks peaked at $2.76 trillion in late 2023. By late 2025, they had declined to $2.63 trillion, a contraction of $127 billion or 4.6%. This is not a slowdown in growth, it is outright contraction. Outside of recessions, loan balance contraction is extremely rare and historically has preceded economic downturns within months. Commercial real estate loans tell a similar story. Total CRE loans outstanding are approximately $3.1 trillion as of late 2025, down from a peak of $3.3 trillion in mid-2023, a decline of $200 billion or 6%. The contraction is concentrated in office properties, where remote work has devastated demand, and in retail properties facing e-commerce competition. Property values have fallen 30 to 50% in these categories, and banks are reluctant to extend new credit against depreciating collateral. Credit card balances and delinquencies provide insight into household credit stress. Total credit card debt outstanding has reached $1.14 trillion as of late 2025, an all-time high in nominal terms. But the charge-off rate, the percentage of debt written off as uncollectible, has risen to 5.2%, the highest outside recessions since 1991. This means banks are writing off approximately $60 billion annually in credit card debt. Simultaneously, banks are tightening credit card issuance. The net percentage tightening credit card lending standards has reached 28 percentage points in Q3 2025, the highest since 2009. Banks are reducing credit limits, rejecting more applications, and raising minimum credit score requirements. This tightening is occurring while consumers are increasing. Revolving balances and delinquencies are rising, creating a dangerous dynamic where access to credit contracts as the need for it increases. Auto loans show similar stress. Delinquencies on auto loans, the percentage of borrowers 90-plus days late, have reached 6.1% as of late 2025, the highest level since the mid-1990s. This is occurring despite relatively low unemployment, suggesting that many employed borrowers cannot keep current on debt obligations. Banks and auto finance companies have responded by tightening lending standards, particularly for subprime borrowers. Auto loan originations have fallen approximately 18% from 2021 peaks. Small business lending, critical for employment and economic activity, is contracting sharply. Small Business Administration loan guarantees, which support lending to smaller firms, have fallen 35% from 2021 levels. Banks report reduced willingness to lend to small businesses due to concerns about economic outlook, reduced collateral values, particularly commercial real estate, and higher default expectations. Corporate bond issuance provides another window into credit availability. Total corporate bond issuance in 2025 is projected to be approximately $1.4 trillion. The maturity wall compounds the problem. Approximately $3 trillion in corporate debt is maturing between 2025 and 2027, requiring refinancing. Much of this debt was issued at 2.4% interest rates during the 2020-2021 zero rate period. Refinancing at current rates of 6 to 9%, depending on credit quality, roughly doubles interest expense. Companies that were marginally profitable at low rates become unprofitable or cash flow negative at high rates. Credit spreads, the additional yield over treasury rates that corporate bonds offer, have widened significantly. Investment-grade corporate bonds trade at spreads of 140-160 basis points over treasuries, compared to typical spreads of 90-110 basis points. High-yield bonds trade at spreads exceeding 450 basis points, compared to typical spreads of 350-400 basis points. These wider spreads indicate markets are pricing higher default risk. Default rates are rising from pandemic-era lows. Corporate defaults in 2025 are projected to exceed 4% of the high-yield universe, compared to less than 1% in 2021. This is approaching the long-term average default rate of 4 to 5% and rising. If economic conditions deteriorate, defaults could spike toward 8 to 10% seen during the 2008-2009 recession. The geographic and sectoral patterns of credit tightening reveal stress concentration. Commercial real estate credit is tightest in major urban office markets, San Francisco, New York, Chicago, where office vacancy rates exceed 25-30%. Retail credit is tightest in categories facing e-commerce displacement, department stores, shopping malls. Industrial credit is tightest in sectors facing overcapacity or secular decline, traditional automotive, fossil fuel-dependent industries. Credit tightening is also hitting specific demographics hardest. Subprime borrowers, if FICO scores below 620, are largely shut out of credit markets. Banks have reduced originations to this segment by over 60% from peak levels. Even near-prime borrowers, scores 620, 680, face significantly reduced access and higher costs. This concentrates credit among prime and super-prime borrowers, reducing overall credit creation and economic activity. Small and mid-sized banks are tightening credit more aggressively than large banks. Regional and community banks, which provide disproportionate lending to small businesses and local real estate, have been hit hardest by deposit outflows and securities portfolio losses as rates rose. These banks are the most cautious, creating a credit crunch in local markets even while national money center banks maintain some lending capacity. All of these data points converge on a single conclusion. Credit is contracting across categories, geographies, and borrower types simultaneously. This is not isolated weakness in one sector that can be offset by strength elsewhere. It is systemic tightening driven by banks and investors' risk assessment that default probabilities have increased substantially and that credit extended during the ultra-low rate period cannot be sustained at current rates. The simultaneous credit contraction across all major lending categories is not merely a data point. It is a signal that reveals the late cycle dynamics preceding systemic credit events throughout monetary history. The first signal is the divergence between credit tightening and official economic metrics. Traditional economic indicators, GDP growth, unemployment, corporate earnings, suggest conditions that are slow but not recessionary. Yet credit is tightening at crisis-like rates. This divergence suggests that credit markets see risks not yet reflected in official data. Historically, credit markets lead economic data by 6 to 12 months. When credit tightens significantly before recession is apparent, recession follows with high probability. This pattern was visible in 2007, early 2008. Credit tightening began in mid-2007 as subprime mortgage defaults rose. But official recession was not declared until December 2007, and most economists expected only mild slowdown through early 2008. Credit markets were pricing severe downturn months before it was acknowledged. By the time official recession was recognized, credit had already contracted so sharply that the downturn became self-reinforcing. Current conditions mirror this pattern. Credit began tightening in early 2023 following the Silicon Valley bank failures. It has intensified through 2024-2025, despite relatively stable economic data. The implication is that credit markets perceive economic deterioration that is not yet manifested in GDP or employment, but is approaching. The second signal is the specific pattern of where credit is tightening first and most severely. Commercial real estate and small business lending are contracting most sharply. These categories are particularly sensitive to economic weakness because they lack the pricing power, financial buffers, and access to alternative funding that large corporations possess. When banks restrict credit to these sectors, it signals expectations of broad-based economic weakness that will hit vulnerable borrowers first and hardest. Commercial real estate credit tightening is especially significant because CRE serves as collateral for vast amounts of lending. Banks hold approximately $3.1 trillion in CRE loans directly. But CRE also backs commercial mortgage-backed securities, CMBS, shadow banking repo lending, and private equity real estate funds. When CRE values fall 30-50%, as they have in office and retail categories, the collateral backing all this credit deteriorates simultaneously. This creates a negative feedback loop. Credit tightening reduces CRE transaction volumes, which reduces price discovery, and forces mark-to-market losses on existing loans and securities, which further reduces bank capital and lending capacity, which further restricts credit. This spiral characterized the 2008 crisis in residential real estate. It is now occurring in commercial real estate, which is roughly the same market size. The third signal is the behavior of credit-sensitive sectors in equity markets. Financial stocks, banks, insurance, asset managers have underperformed broader markets since early 2023, despite overall market strength. Bank stocks in particular have traded at depressed price-to-book ratios, suggesting investors price in credit losses that have not yet been fully recognized in bank earnings. Regional bank indices have been especially weak, trading 30-40% below pre-SVB levels. This is rational given that regional banks hold disproportionate CRE exposure and have faced deposit outflows. But the weakness also signals that markets expect further credit deterioration and potential bank failures beyond the 3 that occurred in March 2023. The fourth signal appears in the credit derivatives markets. Credit default swaps, CDS, insurance against corporate defaults, have seen premiums rise sharply for lower quality investment grade and high yield issuers. The cost to insure against default by BBB-rated companies has risen from 80 to 100 basis points in 2021 to 150, 180 basis points in late 2025. For high yield, CDS spreads have risen from 300, 350 basis points to 500, 600 basis points. These widening spreads indicate that sophisticated investors, primarily hedge funds and asset managers trading CDS, are pricing in significantly higher default probabilities. CDS markets often move before cash bond markets because they are more liquid and involve more sophisticated participants focused purely on default risk rather than yield. The fifth signal is visible in the behavior of corporate treasurers and CFOs. Survey data from the Duke Arndt CFO Global Business Outlook shows that CFO optimism about growth prospects has fallen sharply, reaching levels typically associated with impending recession. More importantly, CFOs are reporting increased difficulty accessing credit and higher costs for credit they can access. This is occurring despite many large corporations having strong balance sheets and investment grade ratings. When even creditworthy borrowers report tightening credit access, it signals that the tightening is driven not by individual credit risk, but by systemic concerns. Banks are tightening lending standards broadly because they expect deteriorating conditions that will affect all borrowers, not because specific borrowers look weak. This broad-based tightening is characteristic of early-stage credit crunches that precede economic downturns. The sixth signal is the reemergence of credit rationing rather than credit pricing. In normal markets, Riskier borrowers can obtain credit by paying higher interest rates. Credit is priced according to risk. In tightening markets, credit is rationed. Many borrowers cannot obtain credit at any price. This is what is occurring now in subprime consumer credit, small business lending, and non-prime real estate financing. Banks are simply refusing to lend rather than offering credit at higher rates. Credit rationing signals that lenders doubt their ability to assess and price risk accurately in current conditions. When uncertainty is high and downside tail risks are large, lenders prefer to stop lending entirely rather than attempt to charge rates high enough to compensate for risk. The shift from credit pricing to credit rationing historically occurs in the late stages of credit cycles, shortly before widespread defaults materialize. The seventh signal is the breakdown of the traditional monetary transmission mechanism. The Federal Reserve has cut interest rates from 5.25% to 4.5% since mid-2024, expecting this to ease credit conditions and support economic activity. But credit continues tightening despite these cuts. This is the opposite of how monetary policy is supposed to work and indicates that credit tightening is driven by factors beyond central bank control, specifically by bank and investor risk assessment independent of policy rates. When monetary easing fails to ease credit conditions, it suggests the credit cycle has reached a point where confidence has deteriorated beyond what policy tools can repair. The Fed can make credit cheaper, but it cannot force banks to lend or borrowers to borrow when both perceive risks as too high. This was the situation in 2008-2009 when the Fed cut rates to zero, but credit remained contracted for over a year until the crisis ebbed. All of these signals converge on the interpretation that credit markets are in the early to middle stages of a systemic tightening cycle that will likely culminate in widespread credit stress, defaults, and economic contraction. The exact timing is unpredictable. Credit tightening can persist for quarters before forcing recession. But the direction is increasingly clear, and the parallels to pre-2008 conditions are growing more apparent. History provides consistent patterns for what occurs when credit contracts systemically after a prolonged period of expansion built on unsustainable lending standards and artificial policy support. The most instructive parallel is the 2008-2009 financial crisis. Credit tightening began in mid-2007 as subprime mortgage defaults rose. Initially, authorities and markets believed the damage would be contained to housing and subprime lending. But credit is interconnected. Losses in one area reduce lending capacity overall, tightening credit to all sectors. By late 2008, credit had contracted so severely that even blue-chip corporations with strong balance sheets couldn't borrow at reasonable rates. The consequence was severe recession. GDP fell nearly 4% from peak to trough. Unemployment rose from 5% to 10%. Corporate profits fell 25-30%. Home prices fell 30-40% nationally and over 50% in hardest-hit markets. The stock market fell nearly 60% from peak to trough. The crisis required unprecedented intervention. Near zero interest rates maintained for 7 years, $4 trillion in Fed asset purchases, $700 billion in TARP bank bailouts to stabilize. The current credit contraction is occurring with even higher debt levels than 2008. Total credit market debt was 350% of GDP in 2008. It now exceeds 360%. Government debt is twice as high relative to GDP. Corporate debt quality is lower. The share of BBB-rated bonds, lowest investment grade, is at record highs. Household debt service burdens are approaching 2007-28 levels despite lower unemployment. This means the system is more vulnerable to credit tightening now than it was in 2008. A given amount of credit contraction will produce larger economic effects because debt burdens are higher. Companies, consumers, and governments have less capacity to absorb income shocks or refinance at higher rates. The buffers that existed in previous cycles have been depleted. For corporations, the maturity wall creates acute vulnerability. Companies that issued debt at 2-4% in 2020-2021, assuming they could refinance at similar rates, now face 6-9% rates and tightening lending standards. Highly leveraged companies, those with debt exceeding 4.5 times EBITDA, are at severe risk. Estimates suggest 15-20% of public companies are technically zombies, generating insufficient cash flow to cover interest expense at current rates and surviving only through refinancing or additional borrowing. If credit tightens further and these companies cannot refinance or obtain new credit, defaults will spike. A wave of corporate bankruptcies would hit employment, reduce investment, lower tax revenues, and trigger losses for creditors, including banks, bond funds, pension funds, and insurance companies. These losses would further reduce credit capacity, tightening credit further in a self-reinforcing spiral. For commercial real estate, the consequences are already materializing. Property values in office and retail categories have fallen 30-50%, but many loans were underwritten at peak values and have not yet been marked down. As loans mature, approximately $1.5 trillion in CRE debt matures between 2025 and 2027, borrowers will need to refinance or repay. With property values down and lending standards tightened, many will be unable to do either. The result will be defaults, foreclosures, and forced asset sales. Banks holding CRE loans will face losses requiring capital raises, reduced dividends, or FDIC intervention for weaker institutions. CMBS investors will face write-downs. Private equity real estate funds will deliver negative returns, triggering redemption requests that cannot be honored due to illiquid holdings. The CRE crisis will parallel the 2008 residential mortgage crisis in mechanism, if not quite in scale. For consumers, credit tightening manifests as reduced access to credit cards, auto loans, and home equity lines. This forces spending adjustment. Consumers cannot smooth consumption through borrowing during temporary income disruptions. Retail sales weaken, auto sales fall, housing turnover declines as potential buyers cannot obtain mortgages. Consumer-facing sectors, retail, restaurants, leisure, contract, triggering layoffs that further reduce income and spending. The feedback loop is straightforward. Credit tightening reduces spending, which reduces corporate revenues, and profits, which reduces employment and investment, which reduces income, which increases defaults, which validates the credit tightening and encourages further tightening. Once this loop starts, it is difficult to interrupt without policy intervention on a scale that creates other problems, primarily inflation if done through money printing, or debt crisis if done through fiscal expansion. For small businesses, credit contraction is particularly damaging because they have few alternatives to bank lending. Large corporations can access bond markets, private placements, or issue equity. Small businesses depend on bank loans and lines of credit. When these become unavailable or prohibitively expensive, small businesses must reduce operations, delay investment, or close. Given that small businesses account for approximately 45% of U.S. employment, widespread small business credit stress would significantly impact jobs. Geographically, the impact will be most severe in regions dependent on sectors already facing stress. Cities with major office sectors, San Francisco, New York, Chicago, will face fiscal crises as property tax revenues collapse. States dependent on retail sales taxes will face budget shortfalls. Energy-producing states could face renewed stress if credit tightening reduces investment in domestic production. The uneven geographic impact creates political tensions and reduces policy effectiveness. Politically, credit contraction and economic weakness create pressures for dramatic policy responses that may worsen long-term problems to address near-term pain. Demands for bailouts, debt forgiveness, price controls, or massive fiscal stimulus become irresistible. The 2008 precedent suggests such interventions will occur. TARP, auto bailouts, mortgage modifications, extended unemployment benefits were all responses to that crisis. But each intervention creates moral hazard for the next cycle. If creditors are bailed out, credit quality deteriorates in subsequent periods because lenders assume they will be rescued again. If borrowers receive debt forgiveness, future borrowers are incentivized to over-leverage expecting similar relief. The interventions that prevent acute crisis plant the seeds of larger crises later. The monetary consequence is that central banks will face pressure to ease aggressively, cutting rates to zero, restarting quantitative easing, providing emergency liquidity facilities. This may prevent financial system collapse, but creates inflation risk, particularly if done while fiscal deficits are already large. The stagflationary outcome, weak growth combined with elevated inflation, becomes probable if policy responses are aggressive. For currency stability, the consequence is incremental erosion. Each crisis intervention, bailouts, QE, deficit spending, creates more currency units relative to real economic output. Over repeated cycles, this degrades purchasing power. The dollar's reserve currency status provides more tolerance for this than other currencies, but tolerance is not infinite. Foreign central banks reducing dollar reserves from 71% to 58% of total holdings over the past 2 decades signals declining confidence that accumulates gradually until reaching a tipping point. The ultimate historical pattern is that credit systems built on unsustainable expansion, artificial rate suppression, and implicit government guarantees eventually face a reckoning where credit contracts regardless of policy efforts. The reckoning can be delayed through intervention, but each delay requires larger intervention and creates larger systemic debt and currency problems. We are in the late stages of this pattern, where credit is beginning to contract despite still low unemployment and modest growth. What follows, based on precedent, is economic contraction that forces policy response at a scale that creates the next stage of monetary system stress. In September 2008, credit disappeared because trust vanished. Banks that had lent freely to each other for decades suddenly refused overnight loans, not because counterparties lacked money, but because the value of collateral backing the loans became uncertain. When collateral value is unknown, credit stops. Within 48 hours, the global financial system faced shutdown. Today's credit contraction is quieter but potentially more insidious. There's no dramatic bank failure triggering panic, no Lehman moment crystallizing systemic risk. Instead, credit is disappearing through systematic tightening by thousands of banks and lenders independently concluding that risks have risen beyond what current prices and terms compensate for. This quiet, distributed tightening is harder to arrest through policy intervention because there is no single point of failure to rescue. When credit contracts because lenders rationally assess elevated default risks across all categories, corporate, real estate, consumer, small business, there is no technical fix. Rates can be cut, liquidity can be provided, but lenders still refuse to lend and borrowers still struggle to service existing debts. The numbers are clear. 18 consecutive quarters of credit tightening. Loan balances contracting by $127 billion in commercial and industrial lending, $200 billion in commercial real estate. Credit card charge-offs at 5.2%. High-yield bond issuance down 70%. Default rates rising toward 4% and accelerating. Corporate debt refinancing into a maturity wall at double previous interest rates. These are not projections. These are current realities. Historical precedent provides no examples of credit tightening this severe and sustained that did not culminate in recession or financial crisis within 12-18 months. Credit is the lifeblood of modern economies. When it contracts, economic activity contracts regardless of monetary policy intentions or fiscal interventions. The consequence of current credit conditions is not theoretical. It is approaching with the same mathematical certainty that characterized 2008. Credit extended at unsustainable terms during zero-rate era must be serviced or refinanced at current higher rates. Credit quality deteriorated during the years of loose lending. Default rates will rise. Losses will materialize. These losses will reduce lending capacity further. The cycle feeds on itself until either policy intervenes at crisis-forcing scale or the economy contracts enough to reduce debt burdens through defaults and deleveraging. This is starting, not in the sense of imminent collapse tomorrow or next month, but in the sense that the mechanisms that create credit crisis are engaged and accelerating. Credit is quietly disappearing, not because of panic, but because the mathematics of debt service at current rates versus the quality of borrowers accumulated during easy money periods are incompatible. One must give. History shows which one gives. Credit disappears, defaults rise, recession follows. Then policy intervenes, creating the conditions for the next cycle's even larger credit problems. The credit contraction underway is the early stage. Recognition of this reality is not yet widespread. Markets remain relatively calm. Economic data has not yet reflected the credit tightening that started 18 months ago. But credit leads. It does not follow. When credit contracts as it is now, economic contraction follows with consistency that approaches certainty. The timing may be uncertain. The pattern is not. It's starting. Again. The same late cycle credit dynamics that preceded every major recession. The same systematic tightening as lenders recognize unsustainable lending. The same quiet disappearance of credit availability before its absence becomes obvious in unemployment and GDP. The signal is clear for those who recognize the pattern. The question is no longer whether credit stress will materialize into economic stress. The question is only how long the lag will be and how severe the adjustment will prove. And history, as always, provides the answer.